Stephanie Link. I'm co-portfolio manager of Action Alerts Plus, and here with me is Jim Cramer. Today we want to talk about financials. Morgan Stanley had a great conference yesterday, Jim. I thought it was very upbeat across the board, and we're overweight the group, so it was kind of music to our ears.
Right.
But it was on loan growth, it was on better capital ratios, it was on better balance sheets, and it was across the board.
Right, and I monitor what Rate Watch puts out. That is the street company. It's they put out numbers for CDs every week, and the rates for CDs for 5-year went down. In other words, you made less, 10 basis points less, but the companies are investing in a 5-year that is giving them a higher rate. So net interest margin is also going up. Now, this group has been the hottest group, and I think people are going to say, well, wait a second, there's always guys who downgrade it because it's up too much. I don't think people understand a banking cycle. A banking cycle can be virtuous when both your net interest margin is going higher from your investments and your net interest margin is going higher from your loans. So there's no reason for this group to stop here.
Right, so the profitability gets better, to your point of net interest margins,
Right.
if rates continue to slowly back up, and we think slowly, it will be gradual, because
Right.
the economy really isn't
Yeah,
taking
we don't
off.
want fast, because then what happens is there's always going to be someone you think is caught the wrong way.
That's right. And on tangible book value, they're trading above the 5 years, but the 10 years, they're well below. And I think as we get back to normalized earnings, which
Right.
we haven't talked about in so many years.
Well, it's been since like when Bank of America had a big yield, big
Yes.
dividend. I mean, we want, of course, these companies to get out from under the yoke on derivative swaps.
Right.
We want them to no longer be having to check in with the Fed when they want to raise their dividend. I mean, all these things have to happen.
Right.
They will happen.
Right. And from JP Morgan, I thought it was interesting. They talked about trading revenue being better than expected. So I think you're going to start to see earnings estimates start to increase.
Yes, that's something new.
And that's good for Goldman as well. So we
Right.
also own that. Wells is talking about costs and keeping them really
Right.
contained.
But-
And that's
they
key.
and they haven't been. And,
Right.
You know, also take a look at the lead story in USA Today. It's about loans being underwater, going back above water. That's been Wells' biggest issue, which is that they've redone a lot of loans. They're almost done doing a lot of loans. And there was a worry that housing prices would not continue to go higher, which would therefore mean that people would start all defaulting again. That's not going to happen if your house goes up in value. You don't want to have it be repossessed if it's going to increase.
That's right. So Wells, JP Morgan, Goldman, Key,
Key.
Hartford, these are all names that we would add to if you do see a little bit of profit taking and a little
Right.
sell on
And
news.
look, we know that there's tumult, as the journal said, and the macro is inferior. But remember, these stocks traded when things were good, so to speak, with the market. They traded badly. Things are not bad with the market if bonds go down and yields go up if you're a banker.
That's right. Great. So we'll stay overweight and add on weakness. Thanks.